All right, thanks everybody for hopping on time here. Looking forward to going through all this. We've got a lot to cover in a short period of time. And as Tony will tell you, when he does these workshops through Veterinary Information Network, oftentimes it can take 2 hours, and I've listened to every single one, and he does an amazing job. We're going to be cramming a lot of information here into 60 minutes. So, and I'll get to the housekeeping stuff before we get started here, but we'll try to keep as many of the questions as possible until the end here as people keep funneling in. So yeah, thank you all for joining us. Also, if you have any friends that want to join last second or come in late, Alex has the Zoom link ready to go. If you're just texting or emailing a friend, you can just email Alex. You should have gotten the invite from him originally anyway, and then he can shoot that invite to your friend if they just want to quickly join on their phone, or if they're at the gym and want to listen like that. It's
Or you
easy.
can
All you
just
gotta do
throw
is
it in,
click on the link. Real easy. Yep.
or you can just throw their email into the chat and I can just send it off that way too. Whatever is
Sure.
easiest.
Yeah, or you can put their email in the chat, and then we can send them a quick invite if they want to hop on, because we're going to do Q&A live too, which will be fun, kind of like a radio style. All right, I see some very familiar names here. Awesome. So, Alex, thank you so much for assisting and letting everybody in here. Tony, I can't thank you enough for joining me. I remember when we did a similar type of podcast, and it was like, what, 4 years ago?
Uh,
And pretty much 80% of that information is now null and void. But thankfully, we have some clarity now with the new bill that came out, at least not maybe, what do you say, 80-90% clarity on some of this
yeah.
stuff.
Uh,
Whatever arbitrary percentage you want to put on it.
Provided it doesn't
Um,
change again, right?
yep.
Yeah.
So again, thank you all for joining us. Again, if you want to invite friends last second, because we're doing live Q&A at the end after the 60 minutes, feel free to put their email in the chat box, and Alex will send them an invite and continue to let people in here. But we are right at 7. So I'm going to go ahead and get the ball rolling, since we have a lot to cover here in a short period of time. And thank you once again. All right. So welcome to the Student Loan Planning webinar. And my company is Medical Advisors Group. Alex is my business partner. Fabian is my assistant. We'll all be here to help you out. And then our special and esteemed guest, Tony Bartels, will be chiming in with his 2 cents. Tony, congratulations. I looked at your LinkedIn today. You are now at 15 years with Veterinary Information Network. So
Yeah. Wow.
time flies.
Yeah.
Which is exactly the same amount of time I've been with AVMA, which is cool. It's cool to see. So dive right in here. All right. So my name is Tim McPhil. Many of you know me. I recognize a lot of your names. I see some new ones. Maybe we met you at a conference or at a clinic, or you've been working with me for years, wherever you are. I've been the Mid-Atlantic AVMA rep now 15 years, but now because of Zoom, one of the silver linings of COVID is that now everybody knows how to use Zoom, not just, tech people and finance people like us. So we're able to help doctors all across the country. And I founded this company back in 2008, starting to work with the clinic that we took our pets to growing up in Northern Virginia. And that's where I'm still based today. But of course, I'm able to work nationally. Alex will be assisting. He's going to be putting helpful links in the chat box, sending out invites last second if you need to, and admitting people. Alex's background is 10 years in the financial planning and investment business with Morgan Stanley, so he's been a great addition to our team. And of course, my esteemed assistant Fabian keeps my head on straight, keeps me organized. I don't know what I'd do without Fabian. He's been here 10 years. And then, of course, there he is. And then, of course, most importantly, we've got Tony Bartels. And what's your pup's name, Tony?
Well, that one's name is Addie. We've got another one named Maggie too, but that's my favorite.
Gotcha. And Tony was crazy enough to have a non-furry child. He's 3.5 right now. So he's a busy man. We are thrilled to have him. And if you're not familiar with Tony, you should be, because like I mentioned, he was one of the people with Paul Pion that helped get Veterinary Information Network going, and really helping veterinarians not only on the back end, but also on the front end, and while they're in school, plan wisely for how they're going to, plan out their finances and deal with their loans. If you're not already a member of VIN, you can sign up for free and then create a login. Actually, Fabian just did that today. I did mine recently as well. And if you're not, follow his podcast. Veterinary Pulse podcast is awesome. I mean, there's just a wealth of knowledge. If you've never been to the website, you're missing out. So go check that out. And anything you want to add, Tony?
No, I'm just looking forward to helping in any way we can. So yeah, but and what I do tell all veterinarians, whether you're a student or graduate or no matter where you're at, is treat your student loans like you do your complex medical cases. You got to do a physical exam of those student loans periodically just to know where they stand and what your options are, because as we all know, those options keep changing all around us. So it's the only way to really understand exactly where to head next with those student loans.
Absolutely. And wanted to talk about your mission. Anything you want to comment here about the mission statement of VIN?
Yeah, no, so most of the student debt stuff we do is through VIN Foundation, which is the nonprofit arm of VIN, the Veterinary Information Network, and the Student Debt Center is kind of the flagship tool there where, anybody can and does use the VIN Foundation tools to help with their student loans, but they're designed specifically to help pre-veterinary students, and veterinarians. So anybody who is a veterinarian can get a log into the VIN Foundation Student Debt Center and get help with their student loans, regardless of your VIN member status. So if you do need some help poking around through there, please reach out and we're happy to help.
Yeah, and I talk to a lot of veterinarians that, they go on the government website, they use those calculators. It is nothing compared to what the Veterinary Information Network simulator offers. You can plug in everything. I've had people that are like, I'm going to have a child in 2026, 2028, and 2030. Because guess what? That would impact your loan payment. You can plug in, if you're going to file your taxes separately or together, you can plug in what you expect your income to be now and in the future. It has literally everything covered. It's by far the best calculator for planning out student loans I've ever seen. So kudos to you and your team for doing this. It's helped tons of veterinarians across the country and other professionals. Anybody with federal debt can benefit from this. Our mission statement, real simple: help as many veterinarians as possible. My career was focused in the Mid-Atlantic, for the first decade roughly. And now, because of Zoom, we're going across the country doing conferences and helping doctors on Zoom. The way that we work is anybody wants to chat with us about your specific loan situation or any other financial topic, we don't charge any upfront or hourly fees. We get paid if people do business with us long term, but zero pressure whatsoever. So if you do want to ever chat with us, many of you I recognize probably not already have. But these are all the types of services we do, just financial planning with a focus on making sure you have a good plan for your loans first, and then making sure everything else falls in line with that. 60 minutes we're going to cover here. And then, I want to make sure Tony stays married because he's got that 3.5-year-old at home and not going to take him too long because his time is very valuable. But I'll stick around as long as possible for Q&A. And hopefully Tony's got a few minutes there as well after the workshop. So with any of your questions, please save them for the end, or you can just put them in the chat box and then we can reference them later because technically this is not a webinar. Technically, this is a normal Zoom. So also make sure to keep your microphones muted. You're welcome to share your video if you want, but make sure to keep your microphones muted until the end, and then we'll just open it up radio style for Q&A. And whatever questions you have, there's probably 4 or 5 or 10 other vets that might be thinking the same thing. So we're going to cover the way things stand today with the different repayment options. And if you're just brand new to this, or you've got 10 years of experience paying loans, we're going to cover the basics and get a little more complicated. The most recent updates on the federal loans, most specifically the new Repayment Assistance Program that comes out in July. So over the summer, the big beautiful bill, or some of the people I've talked to, they called it the big ugly bill. So regardless of your politics, that's the bill that's in place right now. And that's coming out in July 1st of next year. And so that'll be an option. We're going to go through the details of that. How is that different from what you have today? Understanding the new IDR options, income-driven repayment. And then this one, I stress the ideal repayment strategies for your situation. I see so many recent grads, they talk to their parents, trusted advisor, and they're like, hey, just don't have any fun. Don't do anything, eat ramen noodles until you're 40, and then you'll pay off all your loans by then. That's an option, yes, but you might be sacrificing other goals like retirement or starting a family or a home. So they have these income-based repayments in place so that you can create balance in your life if it makes sense in your situation. So, I would refer to an expert like Tony when you're making these decisions, or somebody that has a lot of experience in this industry. We'll talk about private loans, which of course you have to be real careful before you're looking at those, but we'll talk about that as well. And then we're going to go through a couple specific examples, like a recent grad and then somebody that's already been a vet for 10 years. And then we'll open up for Q&A. So that's our agenda today. And It is very detailed. So we're just going to try to focus on the high level stuff, and then you can always chat with us later. Tony does really cool blogs that you can, message him about with your specific situation, and you can talk to us as well. All right, so real quick on this, some of you probably have these undergraduate federal direct loans. The current rate on these for new money, so if let's say if you're a high school senior today and you're looking for undergrad, the rate's 6.39%. Every year it changes. On July 1st, some portion is subsidized, which means the government covers the interest on the loan while you're in school for undergrad, and some portion is unsubsidized. It depends on family income and other factors. And then the government will give you $5,500 regardless of your income or assets. The first year, $6,500. The second year, $7,500. The third and fourth year. So my experience, I see it's like 50-50 the amount of veterinarians that I see that have the undergraduate loans. But of course, for grad school, it's more like 90-10 that have them. But these are loans that anybody can get. But of course, it's capped for the first 4 years at 27 aggregate. And then if there's a fifth year, you can get it up to 31,000 total, 7,500 if you haven't taken the other ones as a maximum. And again, these are all loans in the student's name. So parents don't have to co-sign. Again, it's not based on credit score. And then the grad school loans, which is really why we're all here, is all in your name. You applied without your parents when you got these loans. Again, not based on credit score, and the interest rate is much higher. Right now, it's 8.08% up to the first 20,500 a year. And then above that, which of course many of you have, you've got the direct grad plus loans for cost of living and tuition and fee costs above that amount. And as of today, right, there's no cap on the loans. I mean, Tony, you see it. I see, particularly with some Ross grads and UPenn and some of these expensive schools, 3, 4, 5, 100,000 of debt. But starting next year for new loan borrowers, so if you're a student or prospective vet, it's going to be a $50,000 a year max starting next year for federal direct loans. And that's for, law and medical professionals. But if it's not law or medical, then it's only $100,000 for grad school. That's an enormous difference from what it's like right now. And of course, you always want to make sure that if you're, have the option to, that you explore your health professional service loans because the interest rates are much lower on those, only 5%. And I stole this from you, Tony, from your website. So we can see these rates have been going up pretty consistently for several years, but this is the first year they've actually come down. The only thing that stayed the same is the health professional service loan. So chances are next July, the rates will be lower just because interest rates have gone down a couple times since July. So can't guarantee that, but hopefully the trajectory stays this way on the downside. Okay, so getting into the kind of 101 here for any new grads that are on here, or maybe somebody that graduated a few years ago but just hasn't had to pay because of all the COVID pauses and all the stuff getting held up in Congress. If you just graduated in May, let's say, actually you're probably due to pay this month, 6 months after graduation. That's your grace period, and then you can start your payments. If you don't do anything, I talked to a vet 2 days ago. She's like, they said online that I owe $4,500 starting in 2028. I was like, you got to kind of be careful with what you are reading on your FAFSA login because they default to the standard 10-year repayment. And if you're on Save Now, it might show that online. Just take that with a grain of salt. The loan companies are still working out all the kinks with the government on the websites. But yeah, if you don't do anything, this is the standard repayment. And I'll only stop there, Tony. Anything you want to add on that?
No, this is the season where it tends to get really busy, especially with the 2025 grads. Most of you graduated in May, and then all of a sudden you get that first statement in right around now, and that first payment that's due if you haven't applied for another repayment plan. Just like Tim said, it's going to be a pretty big number, right? If you've got $200,000, $300,000, $400,000 of student debt, I mean, you're looking at a really steep minimum monthly payment, right? And that's where you really want to take a look at some of the options that are available because that standard 10-year payment is generally not a great idea for most new graduate veterinarians or veterinarians, period.
Yeah, it's rare for me to see somebody on that repayment unless they have some family help and maybe they're fortunate enough to only have like, 50 grand of debt or something like that. But for most people, I think it always makes sense. Look at the income-based repayments first, and then you can always pay more, right? There's no penalty for paying above the minimum on an income-based repayment. There's also the option to do extended payments where you do pay off the loans over, up to 25 years. But even those are really, high payments typically. And many of you are probably in still in the save plan, where it was repaid before that, and many people have been able to kind of procrastinate dealing with the loans for a long time. But as of August 1st, if you haven't done anything and you're on save, that the interest has started to accrue. So this has created a big sense of urgency for a lot of doctors to start really addressing this. So this is good timing for the workshop. I don't know if any of you are looking for public service loan forgiveness. I feel like most vets I talk to are pretty familiar with this, but if you work at least 30 hours a week for a registered employer, you do that for 10 years, make sure you're filing all the correct paperwork with your employer. You can get those loans forgiven, and I have seen that successfully happen. The government has improved in that regard. I remember years ago, it was like 97% of people doing it weren't qualifying because they weren't doing enough of the paperwork, but those numbers seem to be improving because of education on this stuff. And then we're going to get into the details of, how IBR and pay works next here. Okay, so I imagine most of you on here are probably eligible for IBR 2014. If you're a little bit of an older doctor, it might be 2009. So it depends on if you took the loans out after 2014, then you would qualify for IBR 2014. So the way it works is you pay 10% of your discretionary income. And discretionary income means income above 150% of the poverty line. So as an example, if you're a single person that just graduated, or maybe you're a few years post-graduation, that number is just almost about 24,000 even, 23 and 750 technically. So in other words, the first 24,000 of income that you earn doesn't count towards your payment. Which can be very helpful because they're looking at your taxes typically from the previous tax year. When you were a student, maybe you're doing a fellowship, internship, residency, et cetera, but maybe your income was pretty low that year. So you're only paying 10% of your income on the monthly payment above that 24,000 of income earned. And then if you're a little bit older of a doctor, then you're paying 15% of your discretionary income on IBR 2009. And one of the cool things, if you use the Veterinary Information Network simulator, and Alex, if you could post the link to the simulator directly to the VIN site, and then also to our site, which gives you instructions on how to download the file, where to go, and how to upload it into VIN. You don't have to guess which one you're eligible for. The VIN calculator will plug that in for you, and so you'll know with certainty. So as you can see, the parameters, the IBR 2014 is generally speaking more generous as a plan because you're forgiven after 20 years and you're paying a lower monthly payment. The challenge is that you have less time to save for any taxes that you would owe upon forgiveness, which we're going to talk about. Anything you want to add on that, Tony?
No, the IBR 2014 is kind of that is a plan that is I kind of refer to them now as a legacy plan because they're because of the changes that happened with the One Big Beautiful Bill. But anybody who's eligible for IBR 2014 is sitting in the catbird seat, so to speak. So it's a really good repayment option. And yeah, the forgiveness does come up a little sooner than it does for the other plans, but that also means you're going to pay a lot less towards your student loan. So if you're not sure which option you're eligible for, it's an either or thing when it comes to IBR. They're mutual exclusive. So you're either eligible for IBR 2014 or IBR 2009. If you're not sure, upload that student aid data file to the VIN Foundation My Student Loans tool, and we've got an income-driven repayment eligibility tab that'll tell you whether or not you're eligible for it. But that 20-year forgiveness timeline is a gift compared to what is remaining for the income-driven plan. So as long as you are thinking about planning for that potential tax down the road soon enough, you can reach that target.
Yeah, and the doctors that I see that are the least stressed out about their loans, after they've been paying for 10 years, are the ones that they get on IBR, which all of you, if you already graduated, you have the option to do, and then immediately start investing or saving or some combination thereof, and try not to procrastinate it. Because I've seen a lot of doctors that they're like 10 years into their repayment, and so they have only 8 years left so that's forgiven because they, just we're either spending too much or just didn't prioritize it because there's always something else going on. When you only have like 8 or 10 years to invest and save, which for like a 6-figure sum, it becomes much more stressful. So the sooner you can get on the savings plan, even if it's just opening up a mutual fund account or a high yield savings account for a few $100 a month, your future self will thank you, and then you'll get used to doing that on an ongoing basis. And then pay as you earn essentially works the same as the IBR 2014. That one will be getting sunset, but you can stay on it for now. And do you want to elaborate on the difference there between that and IBR, Tony? I know it's very minor.
So pay as you earn was kind of the predecessor to IBR 2014. And if you're not eligible for IBR 2014, oftentimes you will be eligible for pay as you earn, which also has a 20-year forgiveness horizon. The most cruel aspect of the new changes is the folks that aren't eligible for the new version of IBR or IBR 2014, but who are eligible for pay as you earn, you're going to lose access to that 20-year forgiveness horizon. And in my opinion, those are the folks that get screwed the most by these changes that have taken place in the one big beautiful bill. So unfortunately, those folks that after July 1st of 2028, when pay as you earn is eliminated, if you're not eligible for the new version of IBR, you're pretty much looking at going into the old version of IBR, which has a 25-year forgiveness horizon, or the new repayment assistance plan, which is a 30-year. So that's going to extend your repayment horizon either way you slice it.
Right. And that's what the calculator or the student loan simulator does. And we're going to show you some examples of that. You can evaluate if you're in that situation, look into the future and evaluate, does it make more sense for me to pay 15% of income and have loans forgiven after 25 years, or under the new RAP plan, which we're going to get to next, 10% of income over 30 years. And what's cool about the calculator is it'll show you the pros and cons of each in a very clear, well, in theory. It's a lot of numbers. If you're not a numbers person, it might be a little overwhelming, but at least it's all in one place and you can kind of make it an informed decision. This is not focused on Parent Plus loans, but I have seen some vets whose parents took out the Plus loans for them. And oftentimes, depending on the parent's financial situation, the doctor is often trying to help the parents pay them back. So if you're in that situation and your parents have loans, they can also get on the income contingent repayment plan, which will be going away, but it is available now, where they pay 20% of the parent's income. But like one vet I'm working with now, her dad is 65 and has a very low income, mostly just Social Security income. And he's got very few bills, house paid off, kids grown up, all that. So his 20% of discretionary income is actually really low payment. And so there could be some forgiveness options there. So she's making the payment for him. So if you're in that situation, you might want to get on that income contingent repayment plan.
That's there's a really special use case for those of you who may be trying to help your parents pay those Parent Plus loans down. If you get those Parent Plus loans consolidated and into ICR before ICR is eliminated, you'll be able to use IBR 2009 on those loans, which is the first and only time they have ever been eligible for anything other than ICR. And IBR 2009 is a better repayment option than ICR. So kind of a niche opportunity for those folks whose parents might be paying back their loans using that plan, but really important to look at that and try to get those into ICR or consolidated into ICR before that gets phased out, so you can have that chance of getting them into IBR.
Absolutely. And I mean, even if you want to pay them down faster, you can still get on ICR, and like I said, and then pay more. You can always pay more than the minimum. So it's a good idea to do just to give yourself more flexibility before it gets sunset. So great point, because the old IBR is 15% of discretionary income, ICR is 20. So that's a great point, Tony. And then, of course, the loans are forgiven, net of taxes. And here's the thing, when you have the tax bomb, which I'm sure most of you are familiar with, where the loans get forgiven, people sometimes forget about this. It's added to your earned, whatever gets forgiven. Let's say it's $200,000. That gets added to your earned income, 15, 20, 25 years from now, when your income is going to be double or potentially triple that amount. So oftentimes it could put you into a very high tax bracket. And it could also be state taxes. So you might want to save maybe you save for a little more than you might even think you need. Because here's the thing: if you have more money than you need to pay the government for taxes, that's a really nice problem. Because you might be crazy like Tony and have a non-furry child that you want to help with college, or maybe you want to put more money into your retirement, or save for a retirement property, or whatever your goals are financially. So one thing I always tell young doctors is it's never a bad idea just to start investing and saving, not just in your 401ks and IRAs. Of course, you want to do that too, but just outside of that, so that you have liquid money to access, and so you don't get into credit card debt, because nobody gets into credit card debt if they have a lot of liquid money. It's when they lack the savings and investments. So just good principles to get used to, and for budgeting and good behavioral finance. And guess what? Chances are you're probably going to need the money for taxes if you have a healthy amount of debt. Okay, so we talked about some of this already. The SAVE plan, which a lot of people are probably on this call, pay as you earn, ICR, they're all getting sunset. But then you'll have the option between now and then to switch over to IBR. So for many of you, that'll be a good option. Now, the tricky part, and I want to hear your opinion, Tony, is I see some of these doctors, they've got, let's say 130,000 income, but like 350 on the debt on SAVE. And it's like, yes, the interest has been accruing since August 1st, but does it really make sense to start paying it when you're just going to be going for forgiveness anyway, until the payments are due? What are your thoughts?
Yeah, so I for the folks that are in the SAVE forbearance, I don't recommend anybody make any payments towards their loans. If you're going to make a payment, at least have it count towards forgiveness. And unfortunately, any payment that you make while your loans are in the SAVE forbearance will not count towards forgiveness. So if you can get a reasonable minimum monthly payment using a plan like Pay As You Earn, then go for it. Right? If you can get a reasonable monthly payment, maybe you're not eligible for Pay As You Earn, but you're eligible for the old version of IBR, go for it, right? If you want to wait and leave your loans and save and let the interest accrue until RAP comes online next summer, and then switch over to RAP, then that's fine too, right? You don't have to switch just because they turn the interest back on, but you also don't want to make payments unless you're going to earn some forgiveness credit. So take a look and see what those payments would be and those other repayment options. And if you can get a reasonable monthly payment that gives you forgiveness credit, then switch sooner than later. If not, you can kind of hang out in the SAVE forbearance for a little longer. I've got loans that are in the SAVE forbearance, and I'm going to sit tight, at least for now, until I get a chance to better compare RAP to IBR 2009, which is where we're likely to end up back in. But I'm not going to make that decision just yet.
Yeah, I'm with you. And one of the things that, and we're going to talk about this in more detail, but one of the things that RAP has in common with SAVE, that's getting sunset, is that once you're on this new RAP plan, if that's the decision you go with, the interest cannot accrue. The government subsidizes it. So one of the things that drives veterinarians and anyone with grad school debt crazy, so like I'm paying like $1,000 a month on my debt and it's going up. So one of the benefits of this new plan, just like SAVE, is that once you get on it, it can't go up. So you could always just wait until July and then switch over if you want to, make sure your debt never goes up again. That is an option. So kind of do the math on how much interest is going to accrue and evaluate there. But I completely agree. But yeah, if you're the higher the debt income ratio you have, like if your debt is 3 times your income, you should probably not be paying anything on the SAVE. You should probably let it ride for now because you're going to qualify for forgiveness most likely. If your debt's more like a 1-to-1 ratio, you probably want to look at getting some credits under Pay or IBR. So again, not everyone's situation is unique, and again, we can always help you evaluate that with your situation specifically. And again, Tony already said this: you got to get on the income-based repayments, Pay or ICR to start the clock again for the 20 or 25 or for your forgiveness. You no longer need to have partial financial hardship to qualify for these income-based repayments. Is one of the changes. This won't come up this year, but at some point next year, we'll probably see some of this for people that are just kind of putting, I call it the ostrich effect, where you're just putting your head in the sand and ignore your loans. They will be able to start with garnishing wages. So you're only going to be able to procrastinate so long if you're just kind of ignoring this, or if you have friends that are. I understand it's a big pain point, but the last thing you want is the government accessing your bank accounts, which they could easily do if you're well past when the payments are due. Okay, so this is probably what most people are going to have the most amount of questions on that we can cover at the end. So these are all the new updates from over the summer. I've been monitoring this closely. Tony has, of course. I've been reading and everything you've done to try to keep pace with this, and it's just been all over the place. But we finally have some clarity. The law is passed, and so for all the veterinarians and many of the people I talked to that were worried about the sky falling, they're going to get rid of income-based repayments. I'm not going to be grandfathered. Thankfully, that did not happen. If you're already on IVR pay, you can stick with what you're doing. Save is going away, but they're still giving you the option. So this has the biggest impact on new loan borrowers where they don't have the option to do the old 10% of income like you've had on Save and IVR 2014. So this has a bigger impact on those folks. But going forward, after July 1st, even for new loan borrowers, for existing loan borrowers, you can stay on IVR, and then you'll have this wrap plan for new loan borrowers. So we talked about this already, but the payments under IBR are based on your discretionary income. So like, again, if you're single, the first 24 grand of income you earn doesn't count. If you're a family of four, the first 48 grand of income that you have doesn't count towards your payment. One of the big differences with the new RAP, Repayment Assistance Program, is there's no income allowance. So if your income's over 100 grand, you're paying exactly 10% of your income. Between 0 to 100, which could happen certainly especially your first 2 years post-graduation, it's essentially the way it works like this. The first 10 grand of income you earn, you pay 1% of your income. From 10 to 20, you pay 2% of your income. From 20,000 to 30,000 of income, you pay 3% of your income. So people that are getting on this RAP plan next year, a lot of times the first couple of years, their payments are going to be really low because they're basing their payments on your last year's taxes. And here's another little tip, just based on my experience. Always give them their previous year's taxes if you want to keep your payment lower. Don't tell them what you think you're going to make the next year, because I've seen some loan companies where they require the tax forms. I've seen others that just take your word for it. It seems to be kind of all over the place. I've seen the same loan company with a different person answering the phone give different answers. So I want to kind of hear your thoughts on all that, Tony.
Yeah, I don't call them unless I have to. So, I will start with studentaid.gov and use the electronic application, and the electronic application will tap into your most recently filed tax return, which for anybody here is probably their 2024 tax return. And if you earned more money in 2025 than you saw in your 2024 tax return, then you want to use that tax return from 2024 to document your income. Your payment will be lower for the next 12 months compared to what you're earning now. So that's the easiest way to apply and have your payment calculated using that, that most recently filed tax return. Now, in the circumstances where your income may have decreased since you last filed a tax return, maybe you switched jobs or took some time off or something else happened where your income is decreased from the previous year, then you don't have to use that tax return and you can submit what's called alternative documentation of income. That's going to require you to submit something that's no more than 90 days old, like a pay stub or something. Or if you don't have any income, you can check a box that says, I don't have any taxable income. But that gets a little bit more complicated, right? So in those cases, I generally open up a Word doc, Google Doc, something, do the math for them, what the payment is supposed to be based on my current, most recent pay stub, and calculate out what that payment is, and then submit that and sign it with my alternative documentation. And if they come up with a different one, then that's when I'm going to call and be like, hey, we need to check in here. Why is your math different than my math?
Yep. Yeah, all great points. One other thing that, besides the fact that your balance, if you do decide to go on the RAP plan in the future, one of the benefits, again, interest and there is still interest on the payment on the downside, but it can't go up. And if you have a child and your monthly payment doesn't cover the interest, the government actually reduces each month the balance by $50. So not a reason to have a child, but it's a lot more generous in that regard.
It happens.
That's why you had the 3.5-year-old. Now I figured
for the $600 a year. Yeah, right.
Yeah, but you're paying probably like $5,000.
She's not covering
for childcare. But the other thing is a little bit different. Is under pay as you earn an IBR and Save, a lot of people, especially recent graduates, had $0 payments because they didn't earn up to the income allowance the previous year of 24, and with Save it was even higher, like 32 of income. Now, no matter what, if you're on this new repayment assistance program, you have a $10 minimum monthly payment. I think the government just wants access to your bank account as early as possible. It's manageable payment, of course, but they just want to get people used to being in touch with the loan companies, I think is the motivation there. And you can file taxes separately from your spouse. So if your spouse has much lower income than you, chances are it could probably be beneficial not to file separately. But if your spouse has a six-figure income, or even like 60, 70 or something like that, you might want to consider separately, because you're going to save a lot of money on your loan payment. And when you talk to an accountant, they're going to tell you always to file jointly, and all else being equal, yes, that totally makes sense to file jointly. But if it means you're paying an extra $1,500 a month on your loan payment, right, that $18,000 a year of extra loan payments, but you only save $4,000 by filing jointly, you got to weigh those pros and cons. There's something I do for people all the time. And this is something you and I were talking yesterday, Tony, about, which is kind of next level, I would describe it as a strategy. But you can switch, if you get on RAP, just to make sure your debt doesn't go up at all while you're having a lower income getting your career started, or maybe you just had a first kid, you're only working part-time, you can actually switch. And I confirmed that when I was doing your research yesterday. Can you elaborate on that?
Yeah, so RAP has a lot of strategic value. There's some great features in RAP. The downside is it's not available yet. But once it becomes available, if you're in a circumstance where your calculated monthly payment is much less than the interest that accrues, then RAP is going to be really helpful, right? As a bridge until maybe your income does generate a payment that's greater than that monthly interest accrual, because the government will cover all of that interest that your payment is not covering. And they'll also knock $50 off the principal per month for every monthly payment that isn't eating into that principal. So you'll actually see the balance go down while your loans are in RAP. Now, the downside is that 30-year forgiveness horizon. That's going to probably not reach forgiveness in most cases. Although for some of you that have high student loan balances and maybe, 5, 10, 15 years of repayment credit already, you may still hit forgiveness at 30 years. But for most of you, RAP is going to probably be more of a temporary bridge that you use while your income is low for a period of time, and then maybe switch back over to a plan like Pay As You Earn if it's still available, or IBR after July 1st of 2028 when pay is gone, so you can hit that forgiveness sooner.
Yeah, because here's the thing: Pay As You Earn and IBR are going to have a lower payment because they've got that income allowance, but interest accrues if your payment doesn't cover the interest. Well, here, $50 goes down. So I'm going to keep a close eye on this to make sure the government doesn't close this, because it would make a lot of sense for young vets to get on this. And then once their income's higher and their monthly payment does cover the interest, because based on their income, then it makes sense to switch to oftentimes to Pay. So this will be something that we'll be keeping a close eye on. So
with the IBR and Pay As You Earn plans, there's actually a cap on the monthly payment that you'll pay that's set at the fixed 10-year amount that was set when you first entered repayment. RAP does not have a cap. So if you were earning $1 million a year, you would pay 10% of $1 million divided by 12 for your monthly payment. Pay As You Earn and IBR, you'll never pay more than that standard 10-year plan payment, no matter what your income is. So it's a way to actually keep your payment from, growing out of control, if you will, as well, when and if you do hit that point where you're earning, quote, too much money, which is another thing that a lot of veterinarians worry about with the income-driven plans. It's like, well, what happens if I'm earning, quote, too much money? And that's generally never a problem, one. But two, you want to, understand how it's going to affect your student loans, and choosing one of the plans that has a cap on your monthly payment like IBR can be helpful in those cases.
Yeah. I need to meet more people that are earning too much money, Tony.
Yeah.
It sounds like a good problem.
It's the new grads. Yeah. They're very optimistic, and they all want to cover that base, and that's cool. We can do that.
Yeah, I mean, it is true. I mean, pre-COVID, I wasn't seeing a whole lot of veterinarians getting signing bonuses. Starting salaries are much higher. I mean, I started working with vets in 2008 when that financial crisis happened. It was a totally different world. So being a veterinarian is a very challenging job, of course. It takes so much education and a lot of debt, but at least you guys are getting compensated more fairly now, for sure. So that has become more of a problem now, which is great to see. Mm-hmm. Now, private loans. A lot of veterinarians in the past, I think more are thankfully to, you, Tony, and many other People at VIN are more educated on this than they used to be. But I saw a veterinarian once. She was consolidated her loans to private with 300,000 of debt because her average weighted interest rate was like 6.8. She talked to a financial advisor who said, "Oh, get this. This was what rates were lower. This one at like 5.5%." I did the math on it through your calculator. It was like $180,000 mistake because she would have qualified. She could have filed taxes separately from her spouse and this and that. So you should, before you ever consider consolidating to private loans, you need to make sure it's absolutely in your best interest because you're not going to have these flexible repayments. You're not going to have loan forgiveness. If there's, God forbid, death or permanent disability, government loans are forgiven. So it's very rare that it's in your best interest to consolidate to private loans unless we're in a much lower interest rate environment. Like I talked to a vet last week who consolidated her loans, but she had like 80,000 at the time that she did it. Her income was 120. So at one point, she had more income than debt and rates. She got a 3.1% interest rate. But right now, you're not going to get that in this market. We still have relatively high interest rates. You're going to get something, if you go online to these different sites, they'll say 4 to 15%. From what I see, it's more closer to the 10 range if you have good credit. So, be very careful before you even think about doing this. Make sure because once the toothpaste is out of the bottle, you can't change your mind and get it back. So it's very situational. That would make sense to do that. If it is in your best interest, great, but you got to be real careful. And if your total amount of federal debt exceeds your income, I wouldn't even consider this as an option. But if you are looking at this, or let's say you're, or maybe you've got, you have a friend or someone's brother or sister that's going to go into vet school, or maybe you heard about this workshop and are going to be taking loans after next year. One of the things that's changing is that you can only take out up to 200,000, which we covered at the beginning, for veterinary school going forward after next year. Well, a lot of veterinary schools cost a lot more than 200,000, especially if you specialize for an emergency or specialty medicine. So this is where the private loans are going to come into play more because 200,000 might not be enough to cover costs, and you're going to have somebody else probably co-signing with you based on your credit history to fill in that gap. So I'm probably going to end up seeing a lot more vets with private loans going forward. And the good news is interest rates have started going down a little bit. So hopefully that trend continues. But if you do that, you got to make sure to ask the tough questions. Are there origination, hidden fees? Can I do prepayments with federal loans? You can, no problem. Sometimes loan companies don't want you to prepay because they want your interest. Is there unemployment protection? You got to ask those questions if it's on the table for you. Okay, and a couple little financial planning implications. We're at 7:40 right now, so we did it, Tony. We're actually on track time-wise. Income-driven repayment is based on your adjusted gross income. So it's not always easy to max out your 401k or whatever simple IRA, whatever retirement plan you have at work, especially when you're young and with lower income. But any amount that you're contributing to your traditional 401k or simple IRA or whatever you have at work will reduce your monthly payment because it's based on your adjusted gross income. And you're saving more for your retirement. I've never met any 65-year-old that's like, oh man, I really wish I didn't save so much for retirement when I was in my 30s. Never heard that one. Right? It's always like, oh, why did I rush into that house? Why did I invest in my brother's new, dating app that he came out with, or this crypto some startup company. Unfortunately, might not be sexy, but it's usually the consistent stocks and low cost funds that do well over time, and every one of your 401k plans or other retirement plans will have that. And so you're not only saving for your own future, but you're also reducing your monthly payment. And if you're going to qualify for loan forgiveness, it's a win-win situation there. We already talked about this. Under the new plan coming out next year and the current payment plans, you can file your taxes separately. In many circumstances, that makes sense. And then don't procrastinate. Saving for the tax bomb that comes in the future. The earlier you start, the better. And again, you can always use that money for other things. You're also, if you start investing and saving for that at a young age, you're also building up an emergency fund at the same time. The idea is not to use it for that, but it's in your back pocket for that as well. And another thing is, don't just focus only on your loans and not on your retirement. I think a good rule of thumb is you should try to put away, at least at a minimum, start with your match, whatever company match you have, or if you can, start with to 10%, and then you can always ratchet it up. When you're doing open enrollment, the health insurance, that's locked in for the year, the life, the disability, all that. But the 401k contributions, you can change it whenever you want. So let's say you start with 10% contributions into your retirement plan. A few months go by, the budget gets too tight. Okay, and then let's say you got to put in 5% to get your match. Then just reduce it to 5%. That's okay. But you should at least look at that. And then I know it's not an exciting topic, but your loans are forgiven in case of permanent disability. Most young veterinarians do not have, knock on wood, right, have permanent disabilities. If they get injured, and it's usually a partial issue where they have some back pain or hand issue, carpal tunnel, whatever it is. So, you might want to look at getting your own policy through AVMA or one of the other big companies like Mass Mutual that I've used over the years. Just to make sure you have your income protected, right? Because your loans are forgiven in case of death. And if you're a single person with no children, the need for life insurance isn't very high, unless you have somebody in your family or somebody else depending on you. But disability insurance, that's just for you. If you can't do your job as a doctor with all the physical demands, and it's a partial issue, both AVMA, Mass Mutual, Northwestern, and some of these other companies, they have student loan riders that not only will they protect your normal base income, but they'll also pay the loan company. They'll pay essentially whatever it is for up to 15 years on your payment, and it's not an expensive rider to add on to those policies. So that's something just from a financial planning standpoint I always try to stress to young vets, because they're like, oh, I've got coverage at work. But yeah, make sure you know how it works and make sure there's you might want to consider getting your own policy too, even if you have it at work, because a lot of veterinarians, they go into relief work and then they go from having insurance through the business, and then all of a sudden they don't have anything. They go to apply and they're my age, 39 years old, and they got a bad back and a bad knee, and the insurance company says, hey, listen, sorry, we're not going to offer you coverage. You have too many pre-existing conditions, or we're going to exclude everything that could possibly go wrong, but we'll still sell you a policy. So the earlier you can get a policy when you're young and healthy, the better. And then next, we're going to go through some student loan simulation examples. And again, can't reiterate enough to continue to go to the VIN site as a trusted resource for student loan information. Okay, so this is a classic situation I see. It's that somebody either gets referred to me or they get my name from AVMA or elsewhere, or we meet at a conference or something. You'll say you're a single vet, you just graduated, or maybe it was a few years ago and you just haven't had to do anything because of the COVID pauses. This could be a similar situation. So this is what's great about the VIN calculator. I ran this morning, and this is somebody with $200,000 of principal and 32 of accrued interest. The average weighted interest rate is 6.9. So in other words, you take all the different loans and you take the weighted average of all of them of 6.9. And so you can see the difference over here of pay and IBR, how the payment is the same. So again, the first 24,000 of income this doctor's earning doesn't count. And if they just graduated, the payment's probably going to be lower the first couple of years because they're looking at their income from the previous years. But once they're a few years in, this is what it would look like. You'd have roughly an $800 a month payment. And then in this example, if you're on, let's say, IBR 2014, you essentially very little happened with your loans over the years. Your payment was enough just to kind of keep it afloat. And then, probably went up initially when you had lower income, and then started going down when you had a higher income. Very common situation I see. And in this situation, your principal forgiven is 200, the interest is 30,505, and then you owe income tax. That's the tax on that amount. So the earlier you can start investing for that future tax liability, the easier. And I know, Tony, you started pretty early, didn't you, for your situation?
I did, yeah. And I'm anticipating having to pay a tax of about $125,000 when my wife and my student loans are forgiven, and we've got more than that on hand already. So I don't have to worry about my forgiveness fund. And I've got about 12 years until I reach forgiveness, and maybe 7 or 8 before my spouse reaches forgiveness. So we've got time to adjust it if we need to adjust it upwards for any reason, or more likely we're not going to need that much. So we could, if our payment goes up, we can pull from it to help cushion the blow of those higher monthly student loan payments. So it kind of serves dual purposes if you can get that started early and often, and actually meet or exceed that goal sooner rather than later.
Yeah, totally. And there's a lot of young doctors I'll talk to. They're like, oh, listen, I don't want to have to rely on the forgiveness programs. I don't know if they're going to be around. Well, what I would say to that, the government could change the law, this and that. What I would say to that is we have an all Republican Congress, executive office, judiciary, everything. And they still grandfathered all the old plans that you're already on. So, I think that the evidence speaks for itself that whenever they've made changes in Congress, they usually have always grandfathered people. They're getting rid of SAVE, but that was technically not passed through Congress. That was an executive action. So one doctor might say, okay, I just want to get rid of these loans. I can't stand looking at them anymore. I'm going to pay $2,690 a month for 10 years. Okay. If that's your goal, it totally makes sense. But, what really matters is that number at the very bottom. This is why I love this calculator. Your effective interest rate, which can be a little confusing. Essentially, that incorporates the fact that you've got certain periods, like grace periods where you don't have to pay, certain parts where the government might be subsidizing things. So what really matters is the effective interest rate on each of your strategies. And if you look at those IBR 2014 and Pay As You Earn, you see a much lower effective interest rate. The reason is because you're not actually paying the loan off. You're paying what the government allows you to pay based on your income. And then the simulator takes into account the fact that you do have to save, like Tony did really well. He's ahead of the curve for the future tax liability. And so effectively your loans are not that interest rate that it lists on the statement. Anything you want to add there, Tony?
Yeah, this was, so when Paul and I initially built this simulator using my circumstances, 15 years ago, we were kind of shocked when we saw, when we put that, what does an average veterinarian graduate with? What does an average veterinarian earn? And then we made some assumptions that projected out in the future. And we started looking at how these plans result. And we're like, this can't be right. Right. But it is, right. This is how they are structured and how they work. And really the quote tax bomb that everybody's terrified of and usually results in people avoiding these plans is what makes them so inexpensive. And the more that is forgiven and the sooner it is forgiven, like in a plan like IBR 2014, the less you're going to pay as long as you can manage all of that savings that comes along with it and you can cover that tax. And you end up paying a very small amount above what you borrowed. And when you do that over a 20-year period, that's why the effective annual interest rate comes out to be so low. And, nearly anybody here can put their money pretty much anywhere and earn more than 3.7% on it, right? So it's kind of a no-brainer to pay the minimum on your federal student loans and plan for the tax on forgiveness as a way to pay the least amount possible towards your student loans. And oh, by the way, it frees up the maximum amount of cash flow so you can do a whole bunch of other things that'll help you grow your wealth long term. So it's just kind of it's a really helpful tool to remove what is that big scary number out of the way from most veterinarians achieving their other more important financial goals.
Yep, all great points. Yeah, my Barclays Capital, the high yield is like 3.9% right now. So, when you're paying extra money above your minimum, you're not really saving, 6.9%. Some people are like, oh, I'm not guaranteed that anywhere. Well, if you're on the income-based repayments, the higher amount of debt you have, the lower the effective interest rate, generally speaking, because you're getting more forgiven. And then lastly, here on the right, we've got the new Repayment Assistance Program plan. You'll notice that, remember, it's the loans are forgiven on that one after 30 years, but you notice it says 26.75. Why? Because you ended up paying it off with those extra 6.6 years. You didn't need the loans to get forgiven. One, because your payment's higher, right? There's no income allowance. That's why you look here. It's a real simple math. Exactly 10%, $1,000 a month or 12 grand a year of this person's income. So higher monthly payment, longer repayment period. They didn't need to get the loans forgiven, and that's why you see down here the effective interest rate is much higher, because you are actually paying them off. So again, you got to weigh the pros and cons.
And I do think that was by design. I think that was one of the ways. This administration really despised the whole concept of the forgiveness option in student loans, and what they did is extended out the repayment term to a point where nearly no one is actually going to reach it with a plan like RAP.
Right, because also those last 10 years above the initial 20, that's when your income is potentially the highest. Right. Or maybe at that point you're a partial owner. Now you become a medical director, or, lots of other factors that go into it. So, it is straightforward, but yeah, this is why if you already have student loans, you probably want to look at the, IBR pay option first and then consider RAP secondly, depending on the situation. Again, it's case by case basis. There's no blanket solution. If you are a new grad, just a couple little tips. The post grads here probably know this. You should always get on the auto debit. Really pinching bills right now because you get a 20.25% discount. You can also consider getting on an income-based repayment before the 6 months of delays if you want to start the clock for forgiveness. And if you're dependent on your parents, it can benefit you to file a tax return so that you can, because like Tony mentioned earlier, if you go into your FAFSA account, you can avoid calling those, God forbid, 1-800 numbers, getting wrong answers. And then they'll already have your tax return on file automatically and see that you had a lower income from the previous year. And that could benefit you. And again, I already mentioned it before, but you can always do the minimum and pay more. There's no prepayment penalties. So you can turn your IBR or RAP or whichever repayment plan into a standard 10 or 15 or whoever. You can figure out a strategy to do that if you want to. If you're offered a signing bonus, which is nice to see more vets getting that, you could tell them to wait until January of the next year if you just wanted to keep your payment lower. Because again, they're always looking at the previous tax years. And you also have a $2,500 interest deduction on student loans, but only up until $95,000. If you earned over 95, there's no interest deduction. It starts at 80, that phases out to 95 if you're single, and then you double that for married. So what usually happens is that usually if the veterinarians are getting any type of interest deduction, it's usually early on because most vets are making more than that. But if maybe you're living in the country and you're an equine veterinarian or somebody that with a lower income in an area with lower cost of living, maybe you do qualify for that deduction. So don't forget that especially if you're doing your own taxes. We talked about it before. If you're looking for public service loan forgiveness, make sure you're filling out all the correct paperwork from yourself and from your employer, the employer certification form. Okay, then this is the last example. So there's probably several of you on here that can relate to this one. Some of them I'm almost positive. So let's say you're married and you're a 2015 vet grad and you've played your cards right. So you have the 10 full years of credits since then. Because even during COVID with no payments, people are still getting credits. And let's say you did specialize in something and you've got a very healthy $200,000 a year income. You're probably, somewhere around my age, late 30s potentially. So now you're like, okay, well, now I got to put a plan together here. So I clarified filing separately. If your spouse had lower income, it wouldn't matter. But I assume for this that your spouse had the same income of $200,000. Maybe you're a doctor, your spouse is an engineer, both very successful, both making high incomes. So in that situation, most likely you're going to want to file taxes separately. Say, okay, option A, 10-year repayment, $4,000 a month. That is an option. But again, look at that effective interest rate. It's only a little bit less than the actual interest rate. And look how much you have to make in payments. Almost $500,000 in payments. So, I don't see a lot of, I don't know about you, Tony. I don't see a lot of veterinarians doing that as an option with this kind of debt load. And then you have the option for 25-year. Okay, I'll stretch it out over 25 years. That's a lot of money to be paying for 25 years. And look at the total payments, $732. Yikes. So for this type of doctor, IBR 2009, which as an older doctor, they might be under that plan. 15% of discretionary income, don't have to count the spouse, or IBR 2014, or pay are probably going to be your best options. Now look at the difference at the bottom there for IBR 2009 versus IBR 2014. Pretty dramatic because the payment is significantly higher under IBR 2009. Still potentially a better option than the standard 25-year, but if you're IBR 2009 eligible, you have to make some tougher decisions, I would say. It does mean you'll have less forgiven, only $93,000 forgiven, as opposed to IBR pay, where you got between the principal and interest, $347,540 forgiven. And again, keep in mind that gets added to your income a decade from now. So if you're already earning 200 now, 10 years from now, you're probably earning 300. Now you've just earned another three something. So to the government, you're making like 650 grand a year. And so in today's tax code, that would put you at 37% plus state income tax if you're in a state that has income tax. So you might need to say this assumes a 35% tax rate, but you should probably be looking at saving 42 to 45%. If you're in California, or I'm going for Thanksgiving where my family is, maybe more. Depends. And Tony, you talked to me yesterday about the whole community property state thing. Do you want to clarify that?
Yeah. So if you live in a community property state, there's often a kind of a double incentive for you to look into filing your taxes separately from your spouse. So, California, Texas are kind of the two big ones there. But particularly if you as the veterinarian have a higher income than your spouse, the way that filing separately in a community property state generally works is you pretty much throw all of your income into a bucket and then have that bucket, right? So half of that income goes on your tax return, half goes on your spouse's tax return. That half that's on yours, if you're the higher earner of the two, is going to be lower than you're actually earning. So you could have a lower monthly payment than you otherwise would if you lived in a non-community property state and filed your taxes separately. So I have seen that in simulations, and we have a feature in the student loan repayment simulator where you can indicate that you live in a community property state, but I've seen that result in hundreds of thousands of dollars of difference in total loan repayment costs, just by virtue of living in one of those states. So look into that. It's definitely worth your time to explore that option, particularly if you live in one of those community property states.
Right. And you also got to keep in mind, if you live in a state with high income tax versus a state like, Texas or Florida or Tennessee or New Hampshire or Washington or Nevada, states that don't have any state income tax. I mean, for this person, that could be like $15,000, $20,000 a year difference at that point that they would owe. So maybe you've got a spouse that's in the military and you could use a Florida address, or maybe you happen to want to move somewhere anyway. I mean, not saying you should necessarily move for this, but remember, when the loans are forgiven, they're just looking where you live at that point, where you're paying taxes at that point. So it can make pretty big impact depending on where you live. Okay, cool. We are right here at 8. Before I finish this, and then we'll open up for Q&A. Just the last one there. Again, the same thing with the Repayment Assistance Program on the right. Again, works very similarly, just no income allowance. And as you can see, because you've got those extra 10 years of payments on this one, sure, initially the balance doesn't go up like it might on IBR or pay as you earn. But over the long term, as you can see, it's a dramatic difference. And this type of doctor, they're like, well, I make a good amount of money, so maybe I should throw some extra money on the loans. But look at the effective interest rate under IBR and pay. I mean, it's less than 0.5%. So really, your best option is probably to pay as little as possible on the loan payment and then invest and save as much as you can, and not just necessarily in savings accounts, but other things like this. Right, savings accounts are kind of the obvious one, and we do have decent interest rates right now, so that's always a good one. Barclays tiered capital is a good option to use because you get credited interest daily. CDs and money markets. You can also do bonds from the government or bond funds or mutual funds and ETFs. Junk bonds, which are like high yield bonds from companies not named Apple and Google, companies you've probably never heard of, but they pay a higher interest rates. What I do for a lot of young vets is we open up a mutual fund account or an ETF account and just plug away every month. When you just graduated, you don't got like 50 grand to invest necessarily, but you can start with 250, 300, 400 bucks a month, start plugging away, and you reduce a lot of stock market risk the longer time that you have. The stock market is very unpredictable day to day and 5-year to even 10-year periods, but over 20 years, the stock market's been very predictable. The worst stock market period in the U.S. history was from 2000 to 2015, and the S&P 500, the top 500 U.S. companies, still did over 6%. So the more time you have, the more aggressive you can be with your investments. Another thing, Roth IRAs. We don't have time to get into all the nuances there, but money that you put into a Roth IRA, you can always take the contributions out for any reason, including loans, taxes on loans before 59.5. Ideally, you don't. Ideally, you use it for your retirement, but a Roth IRA is a great tool to use for pretty much anybody because you're creating an emergency fund for yourself and tax-free growth. So you can use Roths as a part of that. Cash value life insurance, not term insurance. Cash value life insurance is not for everybody, but if you have an insurance need anyway, you can get sometimes within the cash value, maybe 3 to 4% over a long period of time. Cash value life insurance is not a good short-term savings tool, but long-term, you can use the cash for that. Obviously, this is popular. Gold, silver, crypto. I've actually started using gold, silver, and crypto ETFs, which is like a mutual fund kind of, but tied to the price of gold, silver. And those are very cheap. You can open up your account, and I wouldn't recommend putting all of your savings into those. Those are very volatile, high upside, high downside. But, you want to put 5-10% in some mix there. That served people well this year, actually. When the market was down in April, March, that did well. If you have real estate, you can always take a loan to help with the tax bomb. Again, when interest rates are high, it's not a great deal, but when they were lower, 10 years ago, that wasn't the worst plan if you needed it. And if you got a Picasso or Porsche at home, you could always sell that That's obviously not a popular strategy, but it is a one. Or maybe you got inheritance or something like that. You could sell that. So many different ways to save for the tax bond, but I would say the best ones are, high yield savings and using mutual funds and ETFs, a balanced approach to that. All right, with that, we will go ahead and wrap up and open it up for Q&A. So if you want to set up a time with us, I would say at least 30 minutes, but usually it's better if we have 60. You can put your phone up to this and it just links to my calendar. Alex and I will go through your personal situation and help you out. And Alex, if you could put the link as well. So we do everything on Zoom pretty much, unless you happen to live in, the DC area, we could meet in person, but doing everything on Zoom these days for the most part. If you want to chat with us, no fees or anything. I'm happy to just point you in the right direction to start with. And with that, let me once again thank you, Tony, for your time, experience, expertise. You've been an amazing resource for veterinarians across the country and continue to do so now 15 solid years. So can't thank you enough for joining us.
Well, thank you. Thanks for having me. And thanks for highlighting this really stressful topic for most of our veterinary colleagues.
Awesome. All right. Well, cool. So we can open it up for Q&A. So feel free to unmute yourself if you want to jump in, or if you want to just put a question in the chat box. Alex can tell me, and then I'll answer it live. Or if you have a question for Tony, let it rip. Not all at once. All right, it looks like we got something in the chat box here.
All right, so Marissa has asked us, did you say pay plan was going away?
Yeah,
Tony,
unfortunately it is.
Yeah.
Part of the big beautiful bill that was signed into law on July 4th eliminates pay as you earn on July 1st of 2028. So you can use it up to July 1st of 2028, and then it goes away for everybody.
So what would you say is the best solution for somebody like that, Tony?
If it depends on what income driven, I call them income driven repayment profiles. So if you upload your student aid data file to the VIN Foundation My Student Loans tool and you check the income driven repayment eligibility tab, if you're currently using pay as you earn and that's the best repayment plan for you, then stick with it until July 1st of 2028. It's not a bad idea to take a look at the new repayment assistance plan, depending on your circumstances, once it becomes available, and that'll be next summer sometime. But chances are you're going to want to stick with pay as you earn until it's eliminated, and then it's going to depend on which repayment option you have remaining to switch to, and that'll either be the repayment assistance plan. If you're lucky, it'll be the new version of IBR, so IBR 2014. If you're a little bit less lucky, then you'll have to compare repayment assistance plan to the old version of IBR or IBR 2009 and see which is going to be your best option going forward.
Yeah, exactly. So when I've run it, the RAP plan and IBR 2009, it can be a really tough choice because the payment under RAP is going to be lower, but there's 5 more years of payments before forgiveness. So it's definitely a trade-off if you're evaluating those. If you're evaluating pay versus IBR 2014, that's a much better scenario because your payment's going to be pretty much going to be a lateral move from pay as you earn to IBR 2014. There's really not much of a difference, right. And you'll still get full credits for your payments.
And to be, generally speaking, to be eligible for IBR 2014, you would have had to have received your first loan after July 1st of 2014. So that's what the 2014 designation is. So in general, it's veterinarians who graduated 2018 and later who might be eligible for IBR 2014.
Great. Yep. And again, if you're not sure, you plug in your data to the software that we've been talking about. And again, all this stuff's in the chat box that you can access. And again, this is recorded as well, so we can blast it out to your friends and colleagues and everything. Okay. What other questions? Anybody want to throw it in the chat box, or we can unmute you too if you want. Well, Tony, you must have done a good job.
We're very thorough.
Let's see. We got anything else in here? Thank you for the question, Marissa. Okay, we got one new one here. Thank you guys. Thank you for your time and attention. I'm thrilled we actually finished on time. Good to hear from you, Adrian. Good to see some familiar names here. All right. All we're getting
Fantastic.
is thank you. So, yep. Again, feel free to follow up with us. Tony, you're off the hook for any more time. Go home and see your 3.5-year-old and finding some new daycare options.
Yeah, thank you. I appreciate that.
All right, guys. Well, happy Thanksgiving, everybody. Happy holiday season coming up. All the best to your loved ones, and yeah, stay in touch.
Thanks, everybody.
Thank you, guys. Yeah, thanks for the help, Alex, Fabian, Tony, as always. Cheers.
See y'all.
Bye.